Good afternoon. Welcome to Pareto's presentation. Oil is the new oil. Today we're going to talk about the perfect oil bull's cocktail. So what is the picture? Well, we're trading in the high 80s for Brent. WTI is just under $85. That's where we are today. We actually had the physical market hit $90 last week in terms of dated Brent. So we are in a very strong oil price position right now. Why is this? We have alarmingly low OECD stock levels. We have supply outages, political unrest, and geopolitical risks at play right now. And we have rising oil demand despite Omicron as a variant of COVID still raging around the world. So who can provide additional oil? These are the topics we're going to discuss today, and most importantly, is this time different than the last times we've seen these huge bull cycles, be it 2008 or 2014? I'll start with our conclusion. We are bullish for the first half of this year on oil prices. Therefore, we believe oil prices can materially increase from where they are now and will do so. Again, it is because we have very low inventories. It is because NonOpec supply is going to lag in its response to oil prices in terms of bringing additional supply into the market. And thirdly, it is because OPEC Plus remains disciplined as they have never been before in terms of their output increases and are happy with high oil prices. By high oil prices, I mean above $80. So starting with OECD stocks. Here we're showing in the first bar the 5-year average in terms of OECD stock levels from 2015 to 2019. We choose those years because that's pre-COVID. And in 2019, that is when we saw a peak in oil demand of around 100,000 barrels per day. Since then, we had OPEC come, so for 2 quarters, we had enormous inventory builds when the entire world was scrambling to store oil any place possible, especially turning to the tanker market to hold both crude oil as well as refined products. Starting in the third quarter, though, of 2020, we started to draw down on those stocks. So although we were experiencing shutdowns and lockdowns in Europe and North America in the third quarter, we had Asia already coming back, led by China, which started to really consume a lot more oil as fiscal easing, monetary easing, and so forth, other government policies were increasing that appetite for the economy to run harder. We continued to draw down stocks through the end of last year. At the end of August, we had reached what would have been the 5-year average for 2015 to 2019. Therefore, we were at normal stocks, as we would put it, towards how OPEC would describe it, in a normal stock situation. We continued to draw in October, November, and December. And December was quite a big stock draw, as confirmed by the IEA in last week's report. And we are now currently 220 million barrels below that average. So what does that mean going forward? Well, normally in the first quarter, the market expects to have a small build as refiners go into maintenance. And then in the second quarter, we tend to have strong builds ahead of the driving season and high jet demand for summer holidays. When we look at the EIA's projection, we start here with the first 4 bars are showing 2021 levels. We see that they believe that we're actually drawing in this first quarter. We also believe we are drawing in this first quarter. Therefore, we're going even lower than where we were on the OECD inventories at the end of last year. When we look towards the second quarter, the EIA projects about a 600,000 barrel per day build. Now, when we look at what that means in terms of demand and fulfilling demand for gasoline and jet fuel, we actually find that those balances are insufficient. In our own balances, unless we have oil prices well above $100, we actually see a stock draw in the second quarter as well, and then even possibly in the third quarter. So this is where we are in an extremely tight oil situation on fundamentals. That's before we are allotting additional risk of outages in terms of taking out supply from where we are. Now, I expect, especially those of us sitting in Europe, that we remember what has happened to natural gas prices since the summer of last year. We've really had prices skyrocket. Here we're looking at the British NBP price and the Dutch TTF price. And what we saw is that gas equivalent prices in terms of barrels of oil equivalent hit what would have been more than $300 Brent. At a peak, it was around $360. So why did that happen? It's because inventories were so low in Europe. In this right-hand chart, you can see what happened to European gas inventories. That black line at the bottom shows that inventories were below the 5-year range, not below the average, below the range. That's off the charts low. When you look on the left-hand chart, this is where the IEA puts OECD total oil inventory stocks. You see a very similar picture. They actually look at 2016 to 2020, which includes COVID, and that enormous stock build. So if you were to look at 2015 to 2019, the situation would look far more alarming because we'd still be off that range. So does that mean we're going to $300 oil? Most probably not. Why is that? It's because we will see demand destruction coming at that kind of level. Now, let's start with looking at the first immediate risk to the market, and then we'll look at the demand destruction risk afterwards. So, looking at Russia. Russia has been making huge headlines in the last week or couple of weeks as they have been building up troops onto the border of Ukraine. Increasingly, NATO and the US have been caught out in a difficult situation because they want to put pressure on Russia to step back. They're proposing economic sanctions, but they are doing this at a time when Russia has an opportunity that it has never had since the start of Putin's reign. Putin has a real squeeze on Europe in terms of energy, and this is driven primarily by the gas situation. Russia is the world's largest gas exporter. It's the third largest oil supplier. So what NATO can do and the US can do in terms of sanctions are limited by the fact that we still want their oil and gas, especially their oil. The US can supply some gas to Europe, and as can Qatar, in case Russia really does close off the pipeline through Ukraine. If Germany then steps and says, okay, Nord Stream 2 isn't coming online, and then gas supplies really are slowed down or even halted to Europe, then the US, the UAE, and Qatar are all prepared to help fill that gap. But what would the effect of that be? Well, we've already had quite a significant amount of gas to oil switching occurring in Europe and Asia as we had these high gas prices, so demand for oil has gone higher. We haven't had this in the US. The US has been in surplus in terms of natural gas, but there is the potential still to increase supply. U.S. natural gas suppliers are still part of that shale boom industry, and they have been much more reticent about increasing supply too much and killing their own market, as they have been repeatedly punished by shareholders, as has U.S. shale oil. So, as a result, the U.S. still has capacity to switch from gas led demand to oil demand, which would be necessary in the case that U.S. natural gas exports increase a lot to Europe, driving up demand for oil. That will also further appreciate the WTI price. And what we have seen in the U.S. is we've seen a big exiting of WTI shorts, and we've seen a tightening of that WTI price closer to the Brent price as the US becomes more involved in this global energy squeeze story. Now, Russia has two main friends right now. One is China. Russia in December had the largest percentage of Chinese imports in terms of oil. So 8% of the oil that went into China was from Russia. Russia surpassed Saudi Arabia as that main supplier. This is a very important relationship. So even if things were to get worse on the NATO side, Russia will still, in our view, supply China first and foremost. The other major ally Russia has is OPEC right now. Therefore, while historically Russia has been very concerned about the supply by U.S. shale going forward as prices appreciate, Saudi Arabia has not been nearly as concerned about that growth in supply. As we learned during the entire OPEC crisis, Saudi Arabia is calling the shots. Russia doesn't have the backbone to fight OPEC and Saudi Arabia, and especially now with this situation with NATO, we believe Russia will toe the Saudi line. Therefore, if Saudi Arabia is unconcerned about U.S. supply, so will Russia be. Therefore, we see more space for the two to coexist, OPEC and U.S. supply. Historically, to give perspective though, Russia has supplied up to a third of European oil to the market. So it is very significant if we see a postponement or a delay or a lockout of those barrels. Last week when we had the Euros market and the dated Brent market tighten, it is a reflection of actually this concern with Russia towards Europe. Now, the US can be supplying this additional natural gas to Europe and then be consuming more oil to heat during the winter, but then we're still approaching the summer, and this is where the US has a looming driving season. In the left-hand side, we can see here where the US distillate stock level is. It's extremely low. It's off the charts low. In the bottom beneath it, you can see where we are in production. So there is still additional production capacity to increase output for distillates for the winter. But we also need to think about not only the winter, but also the summer, where our expectation is that jet fuel demand will really start to normalize. We had initially had this as second quarter this year in our balances, but we've now extended it across the second and third quarters. We also see the potential for additional demand coming as U.S. shale comes to life, because more rigs will be activated, rigs that are less efficient, that require more distillate to run. And this will be the real boom time. And this is where, in terms of our price forecast, we believe that the second quarter will really show very, very strong prices for oil at the same time when the shale industry will be trying to come to life, and there will be a lot of competition to increase supply, driving up costs, finally creating that cost inflation that we haven't seen in oilfield services for years. On the other hand, the main part of the demand growth is really going to come from gasoline. So as people go on their summer holidays, we expect that to again be coming to a seasonal high. And this is where refiners will need to be creating a lot of gasoline as their primary feedstock into the country. We still see that gasoline production on the right-hand side is still low, and the stocks are low. But refiners are still running winter grades. We have to wait till the end of refining maintenance season to really see that gasoline picture start to change. So in general, to offset this looming crisis of really a lack of oil by the time we hit Memorial Day weekend, who can come to the rescue? Well, let's look to non-OPEC supply. U.S., key. Absolutely key. U.S. shale responds to price. So whereas most forecasters had quite limited growth going into this year for U.S. shale, those numbers have been revised higher. The EIA currently has them at around 600,000 barrels per day year on year. Rystad Energy has them at 800,000 barrels per day year on year. We have FGE at as high as 1.1 million barrels per day year on year in terms of crude and condensate. And that's actually more in line with what we see. We see the potential of 12.8 million barrels per day of oil coming by the end of this year. However, that's by the end of the year. It's not by April, May. So this is where that price is still going to scream higher. In addition, Canada and Brazil are supposed to be bringing in around 100,000 barrels per day of additional growth year on year, but they've been delayed. They had some shortcomings already in December, so we're having to push that out to later into this year. So we have this real supply tightness coming from the non-OPEC picture. When we look at our year-end forecast and where we see U.S. production at 12.8 million barrels per day, we don't actually see much upside to that. It doesn't matter if we're at $110 or $140 at that point. The actual additional possible response is maybe 100,000 barrels per day, 250 max. So we've already accounted for what we think is that U.S. shale growth boom. What about OPEC? So in our base case, we view that OPEC will be coming back to the market by 100,000 barrels per day, month on month, as allocated since last year, right? By the summer, though, we do not have them continuing to increase production. Why? They like high prices. Their spare capacity is not enormous. Currently, we believe they have around 4.5 million barrels per day of spare capacity. However, 300,000 barrels per day are Russia's. Some in the market believe that Russia does not have the spare capacity, in fact, has no capacity, that they cannot even meet their current OPEC plus quotas. Our view, well, we disagree. We actually think that Russia is hoarding oil. So what we can see in the market and going over to Europe makes it look like, okay, Russia is actually short in terms of what it can produce. But Russia, of course, is preparing for a potential war. So they're prioritizing themselves, as they have been with natural gas. And then secondly, they're looking at China, their top trading partner and top ally politically right now. And there were reports this weekend that China and Russia would potentially be conducting naval exercises together, not far from Europe. So that just puts that into perspective. Now, the main contributor in terms of spare capacity is Saudi Arabia. And this, we have them at a max of around 1.9 million barrels per day. They could bring on 2 million barrels per day, we think, tomorrow, but they wouldn't sustain that for a full 90 days. But if there were an emergency, yes, they can do it. So they do have that ultimate ceiling control in terms of the oil price getting completely out of control. However, the economy is still running very well. We still have strong inflation numbers, even as oil prices have started to increase, but not nearly as quickly as everything else has started to increase. So the economies are still chugging along. Would Saudi Arabia want to bring all that on at once without an emergency, like an invasion with Russia? No. They're still a part of this OPEC Plus group. And there are many members in OPEC Plus that are unable to even meet their targets, such as Nigeria, who absolutely do not want a ramp up in OPEC Plus production coming back to the market because they need to attract investment. Why do they need to attract investment? Because we've been trading at $70+, even in the $80 range, and there's still a very difficult market for these countries to attract investors to producing their assets. We see major divestitures happening by the oil majors in non-core countries, non-core regions, non-core grades, even in the North Sea. And so this is that very difficult picture that OPEC is facing. They are looking at the long term, the medium term to long term. They're not looking at just right now. So they need a high enough oil price to stimulate production. We, in addition, see the UAE, Iraq, they have some spare capacity. And then finally, the rest of OPEC Plus. Although, as we saw with Kazakhstan, unrest can potentially make the market nervous if that oil is coming to market. So our view is that OPEC will continue with their increases as they planned in supply until the summer, and then they stop. If they were to continue going higher, then we start to hit really low spare capacity numbers. And when we're below 3 million barrels per day spare capacity, that's when an outage really makes oil prices skyrocket without a emergency stopgap. We've seen China, we've seen the US, we've seen Japan already releasing stocks from their strategic petroleum reserves just to get the oil price down. But they need those stocks for war or outages like we are describing if and when OPEC Plus doesn't have the spare capacity. To raise spare capacity from where they are today, it would take years. So this is where we are for the next 3 years in terms of all that can come into the market. Now, at the same time as negotiating with NATO and trying to negotiate with Russia, the Biden administration is again speaking to Iran. How ironic, the oil market's last hope, Iran. Iran definitely can increase production. And we think they could increase up to 1 million barrels per day, 1.5 million barrels per day of oil to the market. Now that is a lot. However, Biden is in a very tricky political situation right now. The Democrats are looking very weak in terms of foreign policy, as we can see with what has happened with Russia. Putin did not increase his positioning around Ukraine during the Trump administration. He's done so during the Biden administration. Biden has handled Afghanistan terribly by taking those troops out. It, of course, means to many that, okay, there's no commitment from the Democrats in terms of troops. So Biden needs to tread very carefully with Iran because Iran is not popular in the U.S. There is an election coming up in the U.S. So he needs to actually come home with a win on this one because he's not winning on Russia and he absolutely lost on Afghanistan. So the likelihood that Iran is going to come back, even as we currently think, by the end of the second quarter, that looks ambitious at best. So when we look in total at what is most likely to happen, we have the US absolutely ramping up. But it's not ramping up enough to actually fulfill what we see as stronger demand necessary year on year. Last year, demand did grow by around 5 million barrels per day, according to ourselves, according to the IEA, according to the EIA. This year, we're a little more bullish. We think it's going to continue growing by 4.4 million barrels per day. The IEA thinks it's more like 3.3 million barrels per day. The EIA is in the middle at around 4 million barrels per day. But that is where we still need that U.S. supply to come, and we need additional supply stimulus to support things. And whereas we've historically seen that the U.S. comes back much faster in terms of the amount of oil it can bring, we don't see that additional upside beyond 12.8 million barrels per day because producers need to show a margin. You can't just produce every barrel at $85 WTI and be rewarded by your shareholders anymore. You need to be producing oil at $50 a barrel, maybe $60 a barrel, including all costs. So this is where it is much more difficult for all of these U.S. shale suppliers to come back at once. And of course, we will finally see that inflationary environment that we haven't seen come back to oilfield services and come back to shale. So when we think about this year, okay, yes, the oil price has risen a lot. But when we compare that to everything we've seen over the last year, how can anyone afford not to hold oil as an inflation hedge in your book? We believe there is still a lot of upside to come. And although Bloomberg is screaming headlines that, oh, all the shorts are out of oil, that's not true. We see that in WTI. So here on the right-hand side, you see the light gray line at the bottom, well, dark gray line. It is showing how many shorts are in WTI. And we see that has come down to quite a lot of the lows. But when you look at the left on Brent, you still have some shorts in there. But when you look at the longs aren't even in yet. And yes, we can argue that this market's different. we don't have as many investors coming into oil. And that's true because of ESG, because of demand, peak demand coming forward probably in the next 5 years. Some would say even in the next 3 years. But when we see what's happening with all the markets and this pullback, how can you not continue to be in oil when there is no inventory and the world still runs on oil? Oh, we saw in the 70s, you can have very high oil prices, even when things aren't great. So this is where participation in this market, in our view, is absolutely critical. Finally, just looking at, is this time different? Yes, it is. In the left-hand chart here, we're looking at the long-term investment capex guidance versus current spend. And then we compare, and that looks very flat. And then we compare that with the renewable spend. So this is where investors' focus has been off of oil, and so is the producer focus. But guess what? We're still running on oil. We're going to break 100 million barrels per day of oil demand already by this second quarter in our view. And we need that oil to come. We have no buffer, we have no stocks. Therefore, buy oil. Thank you.